What's up, everybody? Welcome to another episode of Swan Signal Live. I'm your host, Sam Callahan, Senior Analyst at Swan Bitcoin. We have an excellent show lined up. I can't wait to get into it. But before we get started, let's talk about Pacific Bitcoin. That's the festival that Swan puts on every year in beautiful Santa Monica. It's happening October 18th and 19th this year. So check it out at pacificbitcoin.com. If you use the promo code SIGNAL, you'll get 10% off. And if you use Bitcoin to pay for your tickets, you get an additional 21% off. So check it out, pacificbitcoin.com. Check out the speakers we have lined up. There's workshops, there's hackathons, there's parties. It's a fantastic time in beautiful California. So pacificbitcoin.com. So I think one of the ongoing trends, I would say, of the last year has been this shift in sentiment amongst institutions when it comes to Bitcoin. It seems like one positive outcome of bear markets is people begin to understand more what separates Bitcoin from other cryptocurrencies, given its properties. And it's kind of the more institutional grade asset, I would say, out of everything. But one firm that has been into Bitcoin way before last year has been Fidelity. They've been mining Bitcoin, I think, way back in 2014. They've been putting out fantastic research on Bitcoin, and it matters because a firm of that size and credibility to be supportive of Bitcoin very early on, they've been really drivers of Bitcoin's adoptions and education over the years. And so I'm really thrilled to bring on the Director of Research for Fidelity Digital Assets, Chris Kuiper, on the show. Chris, welcome. How are you?
Great. Thanks for having me. Great to be here.
Yeah, so I've read a lot of your research that you guys have put out. Fantastic work, and I think let's just get into it. I mean, one of the research reports that really made waves was your Bitcoin First paper that you wrote, I think, in early 2023, if I'm mistaken, or you kind of revisited it. And you really just talked about how Bitcoin is a little bit different, or should be considered different from the rest of digital assets, and that's a conversation that we have a lot at Swan with clients. It can be confusing to understand what the differences are. And so maybe if you could just from a high level talk about what you think are the biggest differences between Bitcoin and other cryptocurrencies today.
Yeah, it was one of our first papers that I wrote when I started at Fidelity, and is still one of the most downloaded, most popular. Originally came out in 2022, I think I want to say, and then we revisited, as you said, kind of refreshed it with our new branding. But all the things in here are very evergreen, and they've really held up for the most part. We make a little more, not prediction, but speculation as to what the future could look like in the latter part of the paper. But the beginning still remains the same, which is the core thesis of why investors need to consider Bitcoin first. Not saying for every investor out there it's the only one, but it should be the first one you consider, not only because it was the first and pioneered all of this, but because it's the most simple in many terms. You know, the Bitcoin network does one simple thing, which is to make sure Bitcoin are moving around, they're not getting double spent, and the number of Bitcoin coming out remains consistent. And so all of these things work together to make Bitcoin very different from everything else. And so because it was the first one, we talk about in the paper how it was like the wheel. Once the wheel's invented, you can't invent another wheel. Everything that comes after it will just be trade-offs or minor variations of it. And that's what we've seen with all these other tokens, other crypto projects. They make trade-offs. They make trade-offs mostly on the three characteristics. If you think back to the trilemma, we've talked about that before, I'm sure, on your show. Security, scalability, and decentralization. Bitcoin puts forth the most secure, most decentralized network. That's what it focuses on. And these other things have made trade-offs in there. And so, again, we like to be intellectually honest. We're not saying these things might have other purposes, but you have to be honest with yourself that you're making a trade-off. And if you consider Bitcoin an emerging form of money and best used or viewed as a form of money, which I personally think and what we put forward in the paper, then you want your money to be the most decentralized and the most secure. If you want it to hold trillions of dollars of value, those are the things you should want to emphasize and make sure it is the best of everything else. And so that's kind of the gist of the paper and what still stands true to us today.
Yeah, it's always made sense to me. I mean, if something's trying to be a new form of money, security is going to be paramount for kind of protecting that scarcity, that 21 million, which is a function of its decentralization. And if that ever gets put into question, I mean, the whole experiment kind of, I think, falls apart. If there's a ton of doubt in whether there's 21 million total supply. That's everything, in my opinion. So all other kind of functionality and scalability moves downstream, in my opinion, from security and decentralization. But it seems like these other cryptocurrencies, they're basically giving up on this idea to compete with Bitcoin as as the digital money, so to speak, or the store of value. And that's also, makes me kind of bullish on it, because it doesn't seem like there's that much competition, where everything else seems to have a lot of competition. They don't seem to have as much moats, or they're looking for a product market fit. Bitcoin seems to really already have one. The world needs something to protect themselves against monetary debasement. These other ones, I'm not so sure. So how do you kind of work through that? Because we've seen kind of Ethereum's market, or kind of competition really come for Ethereum over the last year or so with Solana and other competitors, whereas Bitcoin still just kind of seems like it's in its own thing, focused on becoming that store of value. How do you view things?
That's actually exactly how I view it as well. Two buckets. Bitcoin is one bucket, and it's the only thing in the bucket. Emerging form of money. You want these things. Everything else makes trade-offs. So they're in a separate bucket, but there's all kinds of use cases and things they're doing with it. And some of it's really interesting and really cool, but the problem is you have so much more competition there. And you use some terms that I used to be an equity analyst. A lot of people will kind of pick up on things like moat. You think about a company has a competitive advantage in a moat. Well, what's their moat, right? And people are beginning to assess these things based on how they compare to others of it. So let's take Ethereum, for example. And some of this is my personal opinion. Other people on the research team might have differing opinions. But for me, I agree with you. Ethereum kind of tried to create a narrative of ultrasound money when they switched to a deflationary supply schedule, where you actually had at times, and we're still net deflationary. We've had more Ether tokens burned than issued. And they said, see, it's ultrasound money because the supply is actually going down, whereas Bitcoin supply keeps going up. And we've argued in our research is what makes sound money is not whether the amount is increasing or not, or by how much. Maybe if it's way too much, it might make a difference, but whether or not you have assurance in that schedule, whether or not it's predictable, whether it can't be changed. That's the key function. And let's be intellectually honest here. Ethereum's supply issuance schedule has changed before in the past. It's likely to change again. We have someone who listened to the developer calls last week. They were talking again about changing the issuance schedule because they foresee different problems and things arising. And that just highlights the differences here. I think I'm actually glad Ethereum kind of changed their model, because they differentiate themselves even more from Bitcoin now. And so now they used to both be on proof of work systems. Now they're not. Ethereum's on proof of stake. So you have even more of a differentiator between Bitcoin as emerging money, store of value, and all of these other things. And so again, going back to Ethereum, we're looking at that. And me personally, I'm looking at it and thinking this ultrasound money narrative didn't really work. Ethereum priced in Bitcoin has been declining for a few years now. And now you're looking at competitors like Solana, which, again, going back to that trilemma, it's faster and has a lot more functionality in terms of speed and throughput than Ethereum, but it's not as decentralized. And so now the market's got to figure out, well, how much of a decentralized network do we want to run these things? And it turns out there's some developers who are just starting on Solana and just building everything on Solana. They don't really care about decentralization. They don't care it goes down a few times a day. I'm not saying that's right or wrong. I'm just saying that's what the market is currently valuing. And so they're going to have to find that product market fit to survive. Whereas I think Bitcoin has found its ultimate use case. Some people say, wait, Bitcoin, that's all it does? Store value and act as a money and a payment system. Yes, that is the killer app. It's found its use case. Leave it alone and let it aspire to be that. Whereas all these other things are going to have to compete to try to find their product market fit.
Yeah, the developments in Ethereum, I just consider them different in terms of like the trade-offs you mentioned, but like they're just different technologies, like different consensus mechanisms, different value propositions, different communities, and they just really shouldn't be placed in that same bucket, like you mentioned. But when we talk about proof of work and proof of stake, I wrote in a piece last year the reasons I was bullish going into the year. One of the reasons was that Ethereum had moved to proof of stake for the reasons that you mentioned, just the differentiator there, and having Bitcoin the sole most dominant proof of work consensus mechanism. And now when you compare proof of stake and proof of work, let's get into that a little bit, because you wrote a great piece kind of talking about the merits of proof of work. I mean, there's a lot of misunderstandings, I would say, about it. There's a lot of debate around the energy costs of proof of work, and that's one of the arguments for proof of stake. It's more from an environmental impact standpoint, it's better. But like, obviously, when I look at proof of work, it's actually one of the reasons why I'm interested in Bitcoin. I think it's one of the most beautiful aspects of Bitcoin's design is using energy as part of its consensus mechanism. So what do you think about it? What would you say are the merits of proof of work? Maybe you can compare it to proof of stake at the end.
Yeah, to back up a little bit, just because I had some of those same feelings. A lot of people learn about Bitcoin and then they learn about mining and proof of work later, and rightly so, because it's kind of complex. But because of that, it's always viewed, especially in the media and other places, is viewed as kind of this add-on. Like, well, it's needed for consensus, but it's too bad that it has to use energy, and maybe they could have switched to something else. And it's got this byproduct of having to expend computing power and electricity. And instead, we want to take this paper, and this is one of my favorite ones that I've ever written, because I went through this learning process, similar to your feelings of just realizing this is one of the most beautiful incentive mechanisms ever created to support this thing, which is, it's not a byproduct, it's a feature. Yep. Proof of work is a feature that upholds all of this. And so in this paper, what we tried to do was, I think the subtitle is like a non-technical guide. We wanted to make this accessible to everyone, and especially accessible to investors, because our whole point is, if you are going to invest in this thing, and especially in scale or size, you need to understand proof of work. You need to understand why it works, why it's necessary, and why it's so beautiful. And so I think we successfully leaned on analogies, and we referenced work from other, standing on the shoulders of giants, Jan at your team there, Knut Svanholm, their work there. They have these beautiful analogies of how this network actually works, this proof of work mechanism. And so I think every investor needs to understand at a non-technical level, we don't use even the word hash or knots or anything like that, how this works. And we go through kind of like a voting mechanism and then a lottery. And then how this is actually linked to Bitcoin's investment properties. So again, going back to Bitcoin as an emerging store of value, emerging monetary good, why would you want proof of work linked to that? Well, how does that uphold those actual investment values and that investment thesis? And those two things to me are the same. And so if you think about money, and we think about how gold was money for thousands of years, one of the defining characteristics was it was scarce. It was hard to produce. You couldn't just conjure gold out of thin air. Maybe in a brief period of time during the California gold rush, you could find some in a river. But if you hold an ounce of gold in your hand, it's heavy. And somebody somewhere had to use a lot of energy and power to dig it out of the ground, purify it, melt it, smelt it, whatever the process is. I don't even know what all goes into it, but it takes a lot of work and energy. And that doesn't necessarily give it value. Value is subjective. Some people might value that and they say, great, you put a lot of work into something. I don't care. But it does make it unforgeable, right? That unforgeable costliness. It has a cost to create. And that's what really underlies and backs it. And Bitcoin is the same thing. If you look at a Bitcoin, you can see it's genuine on the ledger, on the computer. Somewhere at some point, somebody expended a lot of computing power and electricity to bring that Bitcoin into existence. And that's a really weird thing that's kind of mind-blowing that I didn't get for a long time until I kind of went through these analogies and reasoned through it. Some of the things we note in the paper is, I think it was Knut who said, Bitcoin's weightless, which is great. You can send it through space, right? But how do you have something that's so virtual, ephemeral, and weightless? How do you make that thing have value? Well, you attach energy to it. You bind energy to it. And now all of a sudden, that thing isn't just some digits on a screen. It actually represents real work that has been done. One of the other ones I've heard is it's a digital receipt for work that has been done. Never before in history have we been able to have something on our screen, something virtual like a file, and know with certainty, without a third party, that work was done to create that. You could do some work for me and I could say, here's a digital token for the work you did, but nobody can verify that. They'd have to go to me or some other counterparty to verify that. But Bitcoin doesn't need that. Just like gold, that ounce of gold in my hand, I don't have to check with someone that work was done. I just know inherently work was done. The same thing is with Bitcoin. I know inherently that work was done with it. And so that's what really anchors proof of stake. And it's it's the feature that should be cherished, not just kind of pushed aside and disregarded, because that is the key thing that links it to that investment thesis as a store of value, as a emerging monetary good.
Yeah, I love it. I think Gigi's done some work too, linking the digital world to the real world through proof of work, and that's the key. And but I loved how you guys framed it, which is, it's so key to the decentralization of the network. And I just want to read a little passage from that piece. It says, "The key point is that to get a credibly decentralized network with no one person in charge, it may be more advantageous to have control over centralization limited by the laws of physics. In other words, the reliance on physical electricity outsources some of the governance to the realm of physics and minimizes the role of human governance. Alternative systems that do not use energy must replace that with other forms of governance in order to limit centralization." And so maybe let's just real quick, you bring up three reasons why electricity itself is it's such a good thing to use for this, for a permissionless censorship resistant network. So let's just go into little specifics for electricity itself, why that's so key to the decentralization of the network.
Yeah, let's see if I can remember the three. I know one of them was it's in nature, it's not discovered, right? So nobody can prevent you from creating your own electricity. You can just make some or harness some in the wind, the waves, solar, burning something, whatever it is. So that right there is very permissionless. I think another aspect of it's global, or at least around the world. So it's not like oil-rich countries or certain rare earth elements where someone could have a geographic control over it. And then it's also homogeneous. So it doesn't have different grades. You can't label it from where it comes from. Electrons are electrons. Again, this is getting back to why physics in the physical world matters. So nobody can say, oh, your electricity came from this source, or it's a different grade, like how we have different grades of oil and other things like that. I don't know if there's other ones in there, but those are the ones.
The last
that come
one is there's no
mind.
limit to the amount of electricity that can be produced in the world. So that limitless property is important.
So if you think of something that does have a limit, someone could buy up a majority of it or all of it, and now they have control. But if electricity is limitless, then the people defending the network have the most at stake. They're just going to keep producing more and more electricity to kind of outbid their attacker. And that matters, because otherwise, if an attacker did a sneak attack and quickly bought up all the electricity, they could have control, and then you would have no chance of getting there. So it makes a difference that this is unlimited, that there's no limit to how much you can produce or use.
Yeah, so they basically, Satoshi had to figure out a way to, like you said, basically have a vote, but have a cost to that vote. How do other systems try to bypass the laws of physics to kind of limit that centralization, those centralization forces? And what are some risks that they could come into that maybe don't exist in proof of work?
Yeah, so when the biggest competitor is proof of stake, of course, which we go through in the paper. And to be fair, proof of stake also works on the same basic principle that you're requiring a capital cost. And so proof of work requires a capital cost in that you have to buy computing power, you have to buy electricity. That requires capital, money. In proof of stake, it's actually more direct. You just buy the actual asset with your money. It's almost a secondary or different form of money, right? But now the problem is you don't have separation of governance. So in proof of work with Bitcoin, you've got three main players. You've got the miners, the nodes, which are just computers running the code and enforcing the rules, but they're not doing the mining work. And then you have token holders. And token holders have no say over the network. Someone with $1 billion in Bitcoin has no more power over the network than someone with $1 in Bitcoin. And that's a very key thing. Whereas in proof of stake, now the token holders and the miners, they're not called miners, they're called verifiers. The token holders and miners, they're collapsed into one role. And so now they are one and the same. And so now you don't have these different checks and balances in quite the same way. So they've figured out other ways to have checks and balances. And again, intellectually honest, it's worked so far. I thought we might see some problems with this, but so far it's been working. So they have demonstrated this is viable, at least for now. And there's different attack vectors that we haven't seen, that some people predicted, but we haven't seen yet with proof of stake. But that's the main key there. Now you have different incentives aligned with that. And the key thing is, because you take out the physical realm as a governing mechanism, you're more relying on social governance. And to be fair, all these systems require some kind of social governance. The Bitcoin system does too, social governance among the people to come to a consensus about what they want in the protocol and whether they want to change things or not. But there's a lot more social governance going on in the proof of stake level. And especially if an attack would happen, it would fall back on the social level. And we saw this with the DAO hack with Ethereum. They all got together and they made a social consensus decision to roll back to the old chain, right? And so that's, I think, one of the key differences here.
Yeah, I mean, you just bring up it's really just about whether it's sufficiently decentralized, and the problem is decentralization is really hard to actually like say objectively quantify like whether that is decentralized or not. That's why like a lot of these other projects can say things like we're decentralized because it's hard to refute them. It's kind of the proof is in the pudding. And usually it's only in adversarial environments or some kind of hack where you actually discover if something is decentralized or not. But you know, when we think about assurances in that schedule, like you said, it's almost like the proof is in the pudding when it comes to whether something's decentralized. And Bitcoin has remained immutable since day one when it comes to the, you know, consensus rules of the protocol itself. It hasn't changed. It's always stayed the same, 21 million. And right now we're seeing some chatter with Ethereum that, like you said, that they could be changing things again. And we have the halving coming up. And the halving is just a perfect example of this programmable monetary policy that hasn't changed because I think Bitcoin is properly decentralized. And so there's a lot of debate over this halving, over what the price is going to do, what it means, what's going to happen to miners. Maybe we can just, you know, tackle that topic and get your main takeaways for what you expect to happen. I think it's a couple days away now.
Yeah, looking at Saturday, I think, is the latest estimate. So very close. And then obviously the big question is what happens to price, or also maybe what happens to miners. And we've written two separate pieces on this. Our analyst, Daniel Gray, wrote one last year already just on the halving itself and some of the price performance in the past halvings. And then our most recent piece was more of it from a miner's perspective. And we actually had a webinar with Fred Thiel, CEO of Marathon, one of the largest publicly traded mining companies. And I think one of the biggest things, just to get out of the way, is this is obviously bad for miners as a whole. The revenue gets cut in half, at least in terms of Bitcoin terms. Some of these miners will have to shut down. And I don't know if they're all some of the publicly traded ones, but that's just kind of the math of it. It reminds me of if you poll people and they say how good of a driver you are, everyone says they're above average. Well, that mathematically can't be true. Not everyone is above average. Not every miner is going to be able to survive the halving. But from an investor's perspective, that doesn't matter because we've seen hash rate drop with each halving event. But the more recent ones, the drop is sometimes as extreme, but it's taken fewer and fewer days. And we have this in our research report, how many days it takes to recover from that drop in hash rate. And I think the last one was a week or maybe a little bit over, whereas before it was maybe 30 days. So still even not that long, but the network will continue to operate as normal. And then on the price side, what people are interested in, of course, is how big of an effect does this cut in newly incoming supply have? And of course, there's a lot of debate about this, and I don't pretend to have the answers, but I was always told in finance never to say the four most dangerous words. This time is different. Although factually, this time is different in that we have an all-time high before the halving. Yeah. And of course, a lot of that, I think, can be contributed to the approval of the ETPs. So we've seen massive demand. It's not just demand from people anticipating the halving. But if you look at, and this is something I've been following, if you look at Google search trends, the last halving, it's just flat, spike on the week, and flat. It's like the halving came and went in a couple days, and it got a little bit of press, and that was it. Some people Googled it. Now you've got the term Bitcoin halving, if you type that into Google Trends, moving up well over a month and a half, 2 months before the halving, and it's still moving up. And I expect it to spike, of course, the rest of this week and into next week, and then it will come back down. And so more people are aware of it this time, and more people, I think this creates a bit of a reflexivity where more people are getting aware of Bitcoin, maybe first from the all-time new high, and then they Google Bitcoin, and then they find out, oh, there's a halving coming soon as well. And then maybe that induces them to buy and then moves price up again, and it repeats. So you've got some reflexivity going on there. In the short term, I don't know, as anyone else does, what's going to happen. Obviously, we've had big drops before the halving. We've had big drops after the halving in the past. Long term, though, I am in the camp where I don't think this is fully priced in. And that's because you're taking off a big chunk of supply. And Bitcoin, at the end of the day, is something that's traded based on simple economics of supply and demand. I think it was Lynn Alden or someone on Twitter said, imagine a whale coming in on just a certain date and all of a sudden just buying 450 coins per day, indiscriminate of price. That's what's going to happen here. The big question to me is whether or not that supply that's taken off is filled in, or even more than filled in, with new supply coming in from long-term holders. Because right now in the data, we're seeing that with the rally, long-term holders are finally starting to move their coins.
Yep.
So late last year into this year, we had a new, once again, this time is different, a new all-time high in coins not moved in over a year at 70%. And now that's coming back down, and you see the short-term holders piling in. And so to connect this back to the ETPs, this might not be as popular with the bulls, but in the short term, I think you could see a lot more volatility, because we don't know who these holders are, the ETPs or the buyers. But given the volume that we've seen and the flows, I have to suspect it's more speculative short-term trading, or some people just looking for exposure. And this is going to be their first cycle, right? And so if we do get a drawdown, there could be some reflexivity there as well, where a lot of these new players, and you see this in the on-chain data, short-term holders driven by ETPs, these new players are going to get shaken out. Again, that's a short-term trend though, but long-term, I think the halving and the demand from the ETPs is a very positive thing over the next 12 plus months.
Yeah, I think we were talking about that recently. The coins, the supply held for 1+ year, I think it's at like 65% now off its all-time high of 70. So it's come down. And then I think somebody over at Bitwise was talking about how he thinks most of the flows have actually been more retail into these ETPs instead of institutional, because they just take longer to kind of make investment decisions, and they need time. A lot of these wirehouses need time to offer it, and it's not fully accessible or integrated yet. And so he thinks a lot of it are retail. So he could be right. It could be more speculative traders, retail traders kind of coming in. Maybe they're trading this event. Maybe it is going to be this like a very volatile event that gets traded. I could totally see that. But then long term, I agree with you. It is
think about like someone who's really bought into the thesis of Bitcoin, of what we're talking about, ultimate store of value, emerging monetary good. If they were that convicted, they would have gotten exposure some other way. At least I think, in my opinion. If you've got conviction, you're going to find a way to get exposure. And there was plenty of easy ways to get exposure before the ETPs. And, it requires maybe an extra account opening somewhere, name your place, but you could have done it, right? It's not like, oh, this is now the only way they got it, and now they finally got exposure to this. The only way I could think of someone buying them with that conviction would be in certain accounts, like 401ks or IRAs or something like that. Yeah, where they couldn't get spot exposure, and now they can get it through those products. But anyway, that was just an aside that I was thinking about the other day.
No, absolutely. I mean, it would be the retirement accounts or the institutional investors. I would feel like it's more for because like you said, if somebody had conviction or learned about it and wanted Bitcoin, they could have. I mean, there's been a lot of maturing in the market, and there's a lot of different venues that they could just purchase it pretty easily nowadays, especially compared to like the last halving epoch, let's say. But this halving is very notable too, because it's actually when Bitcoin's going to become scarcer than gold from a stock to flow ratio, which I think is notable. I mean, people have been talking about it for a long time, but it's where the the annual growth rate of Bitcoin supply is going to go from about 1.7 to 0.85%, 85 bips a year. And gold, I think, hovers around like 1.5 to 1.6 in terms of its annual growth rate. And so what do you think about that? Do you think that's notable? I think from like a narrative standpoint, it could be something that people latch on to. There might be an article or two written about it, but what do you think?
Yeah, you would think people would be extrapolating this and seeing this coming, right? Because it's very known in advance. And we've run the calculations in our reports as well, comparing it to gold. And gold has a pretty steady stock to flow and what's mined every year. So it will continually get higher and higher than gold. And I agree with you. I think that is a point for people to say. I do wonder, though, if that would really push people over the edge, though. If they're a gold bug or they're interested in gold, it's, well, now Bitcoin's slightly more scarce, so it's a higher stock to flow than gold. Is that really going to move them? My personal opinion is probably not, but we'll see.
There's been so much debate over that halving about, it seems like prior halvings, there's been a lot of confluence of events where people are kind of attributing the price increases to the halving, but there's also macro factors that seem to happen in like 2016, 2020. Hurley, if maybe you could throw that chart up of a central bank balance sheet lined up with the halvings. I thought this was a fantastic chart you guys put out last year, but it just kind of shows the central bank balance sheet growth right around the prior halvings, and seeing that, it was a pretty supportive time for asset prices, I would say, during those periods. How much of prior historical price movements would you attribute to actually the halving? I guess it's this idea of is it actually a driver here, or would you say the macro environment is and also like a key factor?
Yeah, this is the hardest question for us on the research team because we have no counterfactual. We don't
Yeah.
we don't have a lab where we can run the experiment again. We can only look back at history, and unfortunately, we can't disentangle these two things. The supply side going on, getting cut in half, but on the other hand, you've got more liquidity and potential more demand, especially with the last one in 2020. Of course, nobody saw some of the pandemic and COVID stuff hitting, so you had this massive demand, and what also coincided with that was a huge increase in inflation expectations. And one of the charts I love to look at is year-over-year change in inflation expectations, which, remember, you're taking a percentage change on a percent level, but because you're talking about inflation as a level, I think it is valid to do that. If the expected inflation goes from 3% a year to 6% a year, that's a doubling of your inflation expectations. So you chart that, and you chart that with the year-over-year change of Bitcoin, and they look like two exact spikes over the exact same time period, and similar to these charts as well. The other one we routinely run is just liquidity. So if you look at year-over-year change in M2, broad money supply of all the major economies in the world, US, Japan, Eurozone, UK, you can even throw in like Australia and some of these other countries, but it's the same thing. Digital assets, Bitcoin particular, follows the year-over-year change in M2. And so I personally think, it is just correlation. I personally think there's theoretical backing and evidence for this of why it would make sense, or at least kind of a sound theory. And even if some people deny it or don't believe it, that doesn't mean the market as a whole is smarter than the sum of its parts. And that's a phenomenon we've explored and academic literature has explored for a long time. And so I think it is correctly reflecting and having a forward look at these changes in liquidity, changes in monetary conditions, changes in inflation expectations. And the one that we wrote about in our last 2024 look ahead piece that we published in January, and I've been seeing it circling around in various forms. I think you tweeted it and other people, which is some form of either the 10-year yield. We use the real interest rate plotted against Bitcoin. As real rates got lower and lower and lower and even went negative, Bitcoin rallied. Makes sense. It's non-cash flowing. Investing is a relative game. Are you going to hold a bond to maturity and ensure that you get a negative return, or are you going to go to something like Bitcoin? But then as the Fed ratcheted rates at one of the fastest paces in history, real rates got higher and higher, inflation came down, Bitcoin did poorly. That also makes sense. The interesting thing was when these two diverged in 2023 and are still diverging, with Bitcoin rallying and rates staying high and inflation still staying relatively low. What's going on here? Is the model broken? Maybe. Do one of these things need to correct, aka Bitcoin go down? Maybe. I'm in the camp that because gold is doing the exact same thing and we're getting new highs in gold, it's sniffing something else out on the macro front. It's sniffing out these structural fiscal imbalances. It's sniffing out maybe a change in liquidity. Whatever it may be, I think it is more forward-looking than what most people are giving it credit for.
Yeah, I did tweet that. I think that's some of the most interesting charts in the markets right now, and whether we are going to see reversion to the mean there, or they are sniffing out this, either the fiscal situation, or, the other thought I had is just, the Fed could maybe use other tools that they have at their disposal that inadvertently lead to more inflationary pressures without touching, the short end, rates. So
we have all these other things to keep track of. I'm losing track of like the reverse repo,
exactly,
the TGPA, whatever it's called, like the Treasury General Account, and all these things that are influencing liquidity. It's hard to get a measure of what's real liquidity and money supply out there nowadays.
Exactly, yeah. And so perhaps, like, that divergence is because of that. It's taken into account all these different. They even say they have more surgical tools to handle, financial instability problems or issues at the treasury market. And that all just leads to increased liquidity in one way or another. And gold and Bitcoin might be reflecting that. But the one thing with the halving that I want to talk about, and like it's something that I believe in. Like I think it makes a lot of sense. I think perhaps the supply dynamics are a bit overblown because with each successive halving, its impact on the total, like say, daily trading volume is reduced. And so, Hurley, if you could throw that chart up, NYDIG had this chart on the halvings supply reduction becoming less important over time. And I think it makes a lot of sense. I mean, what they're showing here is, with the current halving that's about to happen, it's going to be about a reduction of only 49 basis points of the daily exchange volume, because it basically translates to 31 million per day at 70,000 price of Bitcoin. It's about 59 basis points of the daily exchange volume, whereas maybe the first halving, that was about 10.6% of trading volumes at the time. And so it had a much more pronounced impact compared to the current situation. And so NYDIG's big takeaway was they still think, the demand side of things are going to be the main driver. I mean, primarily around these new ETF products being so popular and the inflows into them. They think like heading into this year, it's not so much about the supply side with the halving, it's really the demand side that's going to be the primary driver. So what do you say to that chart and maybe that idea? Because honestly, I think I agree with them.
Yeah, I hadn't seen that chart. That's interesting. I think that makes sense. You've got a smaller and smaller impact. I'm just trying to kind of reason through this in my head. I do think that the demand is going to be the bigger factor here. And if you're thinking of trading volume versus, I'm just thinking of actual supply of coins, is that different? So there could be a lot of trading volume of speculators trading back and forth. And those are all kind of the people in the same camp, the speculators, the tourists, the people who are just going back and forth looking for momentum trades, versus one of the stats we've been watching closely is the number of coins on exchanges continues to go down. So we saw this post FTX, we're now down over 30% in terms of from the all-time high on exchanges. We have 30% fewer coins, not dollar amount, but native coins. And that continues to trend lower. It was even down another 5% year to date in the first quarter of this year. And so what happens if, as these demand things kind of go, as we get more out to that longer curve that we were talking about earlier of everyone taking a core small position, it gets ramped into RIA platforms, people do their due diligence, these products are still stuck in compliance for a lot of firms. So what happens when that demand side ramps up, and those are people looking to hold for the long term, and they go out to buy coins for the long term, not just trade them, and there's fewer and fewer available on exchanges or just fewer and fewer available in the supply because a lot of people have locked these up in cold storage for a year. I think that's one of the things that could maybe counter that
Yeah.
trend.
Yeah, I like that. I think that's a great point, actually. That'd be another interesting some data points to look into, just looking at the available exchanges at each halving as well. I don't know if we have that data going back for those early ones, but that's actually really interesting. That's a good point. So that's the halving. So I think it's an exciting time. Each halving, I'm just kind of like blown away by looking at the growth of the system over the last 4 years, kind of comparing how different it is. One of the biggest changes has been these new ETF products. How have you been like viewing it? I mean, I've been impressed. I think I've been kind of blown away with the demand that we've seen right out of the gate in terms of the inflow. I mean, there's been a lot of coverage on them about how they're breaking records in terms of how fast they're getting assets under management. What's your takeaway? I mean, it's also, I wanted to kind of touch on like the shifting sentiment around Bitcoin as kind of emerging as this, institutional grade asset class, and the ETF products are a part of that, I believe. So maybe you can touch on that too.
Absolutely. Going back to the first part, I got one thing kind of right, one thing very wrong, which I already admitted to. The one I got kind of right was this will be kind of a classic Wall Street adage, buy the rumors, sell the news. We saw a lot of price run up late 2023 into early 2024. We saw the buildup of speculation in terms of the derivatives, open interest, the annualized rate on the perpetual futures for Bitcoin went as high as 30% annualized, I believe. And then that all came in when we got a 20% drawdown. And of course, a lot of people were patting themselves on the back saying, see, big nothing burger. these products came, they had a big show, and they got, you know, a lot of turnover. A lot of that was driven, of course, by one product that was seeing a lot of outflows from its high fee and then into these lower fee products. And of course, that played out as expected. What I did not expect, and I'll repeat it again of how I was wrong, was the massive inflows we saw weeks later. And I think that surprised everyone. I don't think anyone expected that, which is, again, getting back to the question of who exactly was waiting for this product or is buying it. But either way, we can see the flows, and those were extremely surprising and pleasantly surprising, of course. The question is where we go from here. I think, again, I'll just reiterate that I think this is an underappreciated long-term bid, a long-term demand that's going to go into the multi tens of trillions of dollars RIA and advisor market. And that's just going to take time, right? And that might have to go through a few more big drawdowns or cycles. Even in bull markets, we regularly have 30+% drawdowns. So we should expect that. But in terms of sentiment, I think you're right on. The sentiment has changed because it's now in US markets, some of the most liquid markets in the world. It's some of firms' top products in terms of AUM. And it's some of the most traded products if you look on the daily trading thing. So people cannot deny this anymore. And one of the big sentiment shifts I'm trying to kind of gently and politely push on people as I go to these conferences of traditional advisors and stuff like that is, before I was always making the case for Bitcoin. And I say, I'm gonna channel some Charlie Munger here, who I love and respect and admire, even though he hated Bitcoin. So late Charlie Munger, RIP, he would always say, invert, always invert. So flip this on its head. Rather than me making the case for Bitcoin, I would like to hear you make the case against Bitcoin, especially as an advisor. Because if you get back to their lingo, put aside all the investment thesis stuff. Just put that aside and say there's an asset out there that has had some of the highest returns over almost any time period, the highest Sharpe ratio. So sure, it's more volatile, but you're more than compensated for it. And it's uncorrelated over the long term to all of your other asset classes. Traditional finance theory says you need to have this in your portfolio because the only free lunch in finance, as we've been taught through all of our courses, is diversification. If you can find something with a positive return that's not correlated to the other stuff in your portfolio, you will increase the risk-adjusted returns of your portfolio. You are leaving money on the table if you don't allocate to this. And that's why we've seen portfolios evolve over the years, adding REITs. REITs didn't even start until the 90s. I used to cover REITs. Now every portfolio has REITs, real estate. They have commodities. They've got private credit. They've got all of this other stuff. And that's because so far, a lot of these things have shown the diversification helps. So make the case to me why you don't own Bitcoin just from a pure finance quantitative perspective is just one step of the way. And so I think we're going to start to see the sentiment turn. It will really take off, in my opinion, when the career risk is gone. Right now, there's still too many people who, if they do this, they're sticking their neck out. And if something bad happens, they're going to be on the line for it. But if everybody does it, then the career risk is now gone. It's now in the benchmark for everyone. And that's when I think you'll really see it just suddenly take off, because then it's just the game theory of if everyone else has it and all your competitors are getting better risk adjusted returns, you need to at least match that and add it to your portfolios as well.
Yeah, I mean, I have similar conversations. You know, we have a Nakamoto portfolio where you can actually run, custom portfolios and include and look at the risk adjusted returns, Sharpe ratios, Sortino ratios, all that stuff. But like, what are like, we joke because it's like if we just remove the word Bitcoin and they can like remove their biases and remove their preconceived notions and just change that to some other like name and say like, hey, we got this asset with these returns, and this uncorrelated profile.
I've heard of people doing that. I've heard anecdotal reports of people sending someone a tear sheet saying, what do you think of this hedge fund? And it just had the stats. And everyone said, absolutely. I've never seen anything like it.
It's like, I'm in.
This is amazing. And then they say, well, it's not a hedge fund, it's Bitcoin. If I could get away with that on the compliance side, I would maybe try that, but probably best I don't.
Yeah, it's a hedge fund. It doesn't have, annual fees either. So yeah, it's we joke about that, but what are some of the like replies you get when you try to invert that? Like what's still the holdup you get with people? Is it really just a career risk, or is there some, common misconceptions that you come across still today that you have to commonly debunk? Just curious.
Yeah, it varies. One clear trend that I have noticed is the misconceptions continually remain, but they get more and more sophisticated. And so this tells me that there's some people who are just dead set against it, and they will say the latest FUD, the fear, uncertainty, doubt, the latest misconception, of the day, the du jour, like, well, it's too volatile, it's this, it's early things where it's not real, it's only used by computer nerds and dark web people and illicit things. Those have gone away, and now it's more to the, well, there's regulatory concerns, or there's this, or there's that. So there's some that are true, and we have a whole piece out on addressing the common misconceptions, and then also being honest and saying, here's what we think are the real risks. So they've gotten more sophisticated. Some of them truly believe it. Some of them I don't think truly believe it. They just want to be against it. But it varies over all firms. Some people want to do it, but they're still working through regulation and compliance. There's other people that just don't want to do it. I was at a conference a couple of months ago, and the person gave me it's not real. There's nothing backing it. I can't see it. I can't use it argument. Yeah. But then he went on to say that he was a big investor in fine art. And I can see the art and I can enjoy the art. And I said, well, you're obviously enjoying it, but you're talking about buying it and investing in it and holding it. And you said you know the market really well and how much it's worth. So you're obviously ascribing some monetary premium to it, right? So why not just invest in something that has a pure monetary premium? There's no subjective value as to whether the art is good or bad or in vogue or out of vogue or something like that. I don't think I got through to him. Maybe I should have tried more of the attack. I've been thinking lately of what we just talked about with proof of work, where what's backing it is true energy that's been expended. Maybe that's a better tactic. I'm not sure, but it's still a lot of the same stuff, unfortunately. But it just takes time for these things to change in people's minds and for kind of the collective perception of it to change as well.
Maybe you got to get that guy one of those old Cassius coins, those physical Bitcoins. That'd be perfect for him.
You can hold that, right?
Yeah. I go back and forth. I mean, to me personally, the backed by energy, I actually think Bitcoin's kind of backed by its monetary properties is the way I think I believe it. Like I frame that, like backed by energy is more about like the security and preventing like 51% attack. But in terms of actual Bitcoin's value, it's monetary properties, similar to gold's monetary premium, right? I mean, Peter Schiff was just talking to my fiance on Fox News about this, talking about the intrinsic value. And he talks about the central banks buying gold. And I'm like, do you think they're not, buying it because they're all trying to get second jobs and open up a dental practice or something, like building electronics? No, they're buying it for its monetary properties. It's so silly. But then he says like, well, Bitcoin doesn't have an intrinsic value. Gold has industrial use cases. It's used in jewelry. But you really have to focus on the monetary properties. And that can be hard for people to kind of grasp, though, that idea that Bitcoin's value, what actually backs it is its superior monetary properties. And
so here's an interesting one I want to ask of you that I've been thinking of, and I don't have any answer to it. But in grad school, we had a monetary theory class, and Bitcoin was still very early back then. It was 2015. And they're making the point that all money through history started with something that had, quote, intrinsic value or was used. So usually a commodity. You start with commodity monies. And then it became a money that was redeemable in that commodity. And then as we've seen through history, they sever that link to the redeemability of it, as all countries have done. But the point was, it was always built on a foundation or bootstrapped off of that original utility, which is where I think people get this idea of, even if they know and believe that gold is mostly a pure monetary thing, that little bit of utility somehow
that's how it started,
gives it a foundation. And never before in history have we had a monetary good just be launched as a pure monetary good. And I think that's correct. I don't think we ever have had that throughout history. So I'm wondering if that does change the narrative or perception, or just people have never encountered this, a pure monetary good launched out of nowhere, not bootstrapped to something else, not redeemable for something else. It was just purely a monetary thing that eventually emerged as a money. I'm not sure.
Yeah, and I think that's actually an advantage too. I mean, if it's actually going to function as money, you don't have any distortion in the price of money itself. If it's being used for other use cases, it's a pure, 100% monetary premium. And so it has the information that you need, which is to, coordinate price signals and facilitate trade in the economy. between individuals. And so like, to me, it's actually, if you go one step further, it's actually an advantage that Bitcoin has, that it's not used for any other kind of industrial use case except to function as money itself.
I think on paper, I completely agree. It's an advantage. It's just pure money, and it's got all the best qualities. But for the adoption part of it, that's what makes it harder for people for whatever reason. They just can't trace the linearity back to something else.
Yeah, no, and I can't remember specifically. I would have to go back to my notes, but I don't know if you read Lynn Alden's book, Broken Money, but
We
she
did.
goes into that, like the history of like the different theories of money. And I remember those early chapters, but not well enough to speak on them right now. But I don't know. Have you read that book? Like, I'm just reminded of it. I was like, I know she talked about this.
Yeah, that was the last book we read on the research team here. We do
Oh,
kind of
cool.
a book club, book reading. So we read that, we worked through that one. And yeah, she does go through that. And of course, we talked about the debate of whether early money was always emergent out of commodity, like Menger's theory, origins of money, or whether it came out of a credit-based system. And it's interesting historically to think about this, but at the end of the day, it's like, well, we're here now. What are we going to do with this now?
Yeah. No, it's interesting. I did learn a little bit more about the other side of the argument from Lynn's book. It had a little bit more logic to it than I originally thought. I'll admit that. But yeah. Anyway, everyone should read Broken Money. I think it's a fantastic book, and I hope you enjoyed it too. But can we just, like, before we go, I just want to, like, you did bring up there's actually legitimate concerns, and I think it's important to always think about the risks of any investment or any, you're going to put money into something, you got to understand the risks. So for our listeners, what do you think are like legitimate risks beyond like the typical narratives that we always hear in terms of the criticisms that might be not as legitimate? What do you think people need to be aware of?
Sure. So one of the ones is regulation can slow adoption. Now, we specifically said slow because I don't think it will ever shut it out. Never underestimate the power of poor policy or something like that can distort things or change incentives. But I think the window has passed now. We were just talking about $1 trillion exchange traded products. So hopefully that window is passed. But it is still something people need to consider. The other one is a bug in the code. Bitcoin has had 2 bugs in its code in the past. So let's be honest about that.
Yeah.
And there's no guarantee there might not be ones in the future. I think the probability is very small because we've gotten this far and so many people have poured over the code. But we've also done upgrades to the code, SegWit, Taproot. And while they're, from my understanding, I'm not a programmer, completely vetted and things go very, very slow and methodically, you don't want to break anything. Who's to say some ingenious person might find something that messes it up? We've seen inscriptions come along, and I'm not saying anything for or against them, just purely pointing out here that nobody foresaw inscriptions when we did these other upgrades, right? As a potential thing to do. Yeah. The third point we point out is just the unknown unknowns. You have to, as an investor, think there is a non-zero chance that there is a risk out there that you don't even know is a risk yet. We need to be humble enough to accept that. And not everything is just ultimate certainty or inevitability. And then another one that we didn't add into the report, but I was just listening to a podcast where this was brought up, was kind of this idea of Bitcoin's code, whether or not it should be more ossified or not, or whether it needs to change. And there's the risk that changes in the code bring in a bug that brings the network and the value down, like I mentioned. But I think there's also the risk of people changing it so that these core principles that we've been talking about this whole time get skewed or misaligned or something breaks there. And the only analogy I can come up with, and I don't mean this to be political in any way, but if you think of something like a constitution for a country, it's just a piece of paper. It relies on all of its citizens upholding those values. It's not the paper or the law itself that's going to restrain it, because people can change the paper. People could, in the very far future, probably not go back and listen to interviews like this and have different ideas of what Bitcoin should be or what it should do. And they might change it, maybe, and it's even well-intentioned, but they changed the whole incentive structure. And I think we have to be honest about that too. But this was something I was just thinking about the other day. It didn't make it into the paper, but one I'm going to add to the list, I think.
I think that's completely fair. And I think it just goes to show like we have to be very, very cautious with any kind of changes. And that's what kind of the history of Bitcoin has been. But I hope we continue to have that, you know, I guess part of our community, which is to be very thoughtful about any changes because there has been kind of unintended consequences. And perfect example, I mean, I'm not trying to like knock on Ethereum or anything, but every single time they make a change, there seems to be these unintended consequences. And it kind of, the more complex it becomes, the more like the attack surface grows and the more there can be kind of some kind of problem. And we don't want to kind of make the same mistake with Bitcoin and start changing things just to add this functionality that could potentially threaten the underlying, things that make it so special in the first place, I guess. But the regulations, I think you're right. I think the ETFs coming out. I mean, right now we got so many like retirement accounts. Americans hold it. The tens of millions of Americans hold Bitcoin. That's what's estimated, and now it's in retirement accounts, 401k accounts. It's becoming more and more ingratiated into people's futures and their savings, and so to me that kind of passed. I think you have even like pro Bitcoin candidates, coming up. There's pro Bitcoin elected officials, the Cynthia Lummises of the world and others, Patrick McHenry. All these ones are there, and I think you're going to see more and more support for this as more education comes out. So I do think regulations could slow it, but I think it could also go the other way. It could actually increase it too. People losing interest was another one, and it just doesn't seem like that's happening. Maybe I'm in a bubble. I don't know. It just seems like people are getting more and more interested. I mean, we talked about how that you brought up the Google interest of halving, and now we have CNBC anchors screaming, "The halving's coming." So it just seems like the interest is only growing. But I think those are legitimate concerns. The inflation bug too is I just remember in like 2018 there was a scare there, and that kind of woke me up. Like, okay, this is still software. Like, we got to be careful and we got to be very deliberate with what we do with it because we don't want to destroy this beautiful thing we have. And so those are just my summary of everything. But I think those are legitimate concerns. I think it's important to keep in mind there are risks. There are valid criticisms to Bitcoin. And it's important to be aware of them if you have your money in it.
Yeah, absolutely.
Yeah. Well, Chris, thank you so much for coming on. Like I said, if anybody hasn't read some of the research coming out of Fidelity Digital Assets, I mean, I would go back years. I would just read a lot of what they put out because they put out fantastic work. Chris specifically did a great job, like explaining proof of work in a way that is easily understandable. And so if you're not very technical or you kind of get overwhelmed by some of the technical jargon, I highly recommend you check out that. You'll learn more about what mining is, what proof of work is. And then there's Bitcoin First article too is fantastic. So Chris, thanks for coming on the show. Just really appreciate it. Where can people maybe, read more of your work personally or follow you on social media?
Yeah, I'm on X, Twitter, at Chris J. Kuiper. And for all of our research, you can either see it there. We also have a at Digital Assets handle. And then there's fidelitydigitalassets.com.
Awesome. Well, have a great day. I appreciate it. And happy halving.
Yeah, happy halving. This has been great. Thanks so much for having me on.
Thanks, Chris. Well, that was fun. He's been on my list for a long time to talk with, and you probably see why. He's very intelligent. He's in a position where he kind of can see what's happening on both sides, the Bitcoin industry as well as the traditional financial world. And I think those worlds continually to merge into one another, and bridges are being built. And Chris has a really good, angle to kind of witness what's going on there. So I really appreciated his insights and his team's work. So check it out at Fidelity Digital Assets. Thanks to Chris for coming on the show. Hope you guys enjoy it. Let me know what you thought. Like, comment, subscribe. Always helps us get the message out. So you sharing our work is really, really helpful for us. And then check out Pacific Bitcoin, pacificbitcoin.com. That's the festival we put on. 10% off if you use the promo code Signal, 21% off if you use Bitcoin with that. And so thank you so much for listening once again, guys. Next week, got another excellent show lined up for you guys. I think you're going to really enjoy the guests that are coming on. So make sure you tune in, and I am out. Thank you.